The foreign exchange market, also known as the FX and currency market, is the largest financial market in the world in terms of volume traded daily. With over $6 trillion being exchanged across this market 24 hours a day, 5 days a week, it offers the perfect amount of consistent liquidity and time for traders to make money. Once upon a time, trading currencies was usually something people would only do when necessary, such as travelling abroad when they needed to exchange their home country's currency for the currency of their holiday destination. This generally involved going to a bank, foreign exchange broker, or exchange bureau at their local high street or airport to complete the transaction. The bank, broker, or bureau would offer an exchange rate, often slightly inflated from the actual live spot price, to ensure a little profit is made from each transaction. Many years back, this was predominantly cash-based. If you were based in the UK and going abroad to the States, you would have handed in your pound notes and received US dollars in return. Nowadays, when you see the words Forex or FX, it's likely a reference to a similar practice of exchanging currencies, with the only exception being that it is for investment purposes. Similar to the stock market, where traders aim to profit from the price valuations of individual stocks, Forex traders are focused on the same incentive. The only difference is that they are speculating on the potential price movements of different currency pairs, and trading based off the idea that the exchange rate will either decrease or increase. A good example of this would be the pound and dollar mentioned earlier. At the current time of recording, the live exchange rate for the pound versus dollar is approximately 1.32000. Forex traders use numerous different sources of information, such as price charts and fundamental news announcements, to decipher whether or not the price of this currency pair will either surge or plummet. The value of a currency tends to move in synchronization with macroeconomic factors relative to the country's currency. With enough capital, a move in the exchange rate from its current price of 1.32000 to 1.32500 would be sufficient to earn a pretty good penny. A common misconception of Forex is that you are exchanging physical currency. Forex trading is purely digital, speculating over live exchange rates. You're essentially buying and selling currency you do not physically own or receive. Traders utilize tools such as margin and leverage, something we'll be covering in depth in future lessons, to capitalize off the volatility of the Forex market. In its simplest terms, leverage and margin are borrowing facilities offered to traders via trading platforms and brokerages to borrow capital and increase the potential profits to be made from the change in exchange rates, as without a large amount of units being bought and sold, the profit would be far too minimal to be considered worthy of one's time. We briefly touched upon macroeconomic factors causing the price fluctuations of the Forex market, but the rabbit hole actually goes much deeper than just global fundamentals. Unknowing to many newcomers, the FX market is heavily manipulated by various entities. There are multiple participants of the Forex market who arguably cause a much more significant impact on price movement. It can also be argued these sometimes less well-known participants are the sole driver behind most large movements in the present day. Once we can understand who these entities are and how they operate, we can better adapt to the ever-changing dynamics of the FX market and comfortably position ourselves to move in line with these market makers instead of ending up on the opposing side. Similar to a blockchain, the market has no physical location. It is decentralized, essentially operated by a network of computers consisting of large banks acting as liquidity providers. The foundation is built on what is known as the foreign exchange interbank market, an arena for the largest market players, that being over 1,000 banks, to exchange currencies directly with one another or through a brokerage. Look at it like a pyramid hierarchy structure, with the most influential elite at the top and the smaller players trickling down to the lower end of the system. The FX interbank market is considered to be the wholesale market, where the banks constantly offer quotations on the best possible bid and ask price they are willing to exchange at. The bid price being the maximum a buyer is willing to pay, and the ask price being the lowest a seller is willing to accept in exchange. This is why the term market maker is used, because it is these large banks engaging in frequent currency exchanges that set the ever-changing exchange rates you see on your charting software and brokerage platform. Central banks can be considered as the top level also, as the alteration of interest rates can have a significant impact on where the price of an exchange rate will head next. As we move further down the pyramid structure, we face other market participants such as small banks, hedge funds, corporations and Forex brokers. Whilst the network of larger banks providing the liquidity for the interbank market caters for over 50% of the entire multi-trillion daily traded volume, thanks to billions of currency units being bought and sold, the network of small banks, hedge funds, corporations and brokers play a crucial role in market volatility. Whilst these participants trading alone may not do too much to cause a shift in the market, combined as one, they can be a true force to be reckoned with. Insider trading, often a coordinated event between these entities to cause short-term volatile moves to the market, has also become a foundation of how Forex operates. You have probably stumbled upon at least one article in your lifetime showcasing another bank or trading firm fined multi-millions of dollars for insider trading. These groups work together to premeditate moves that will impact the market in their favour. Understanding this can positively impact your trading results. For every winner in the market, there has to be a loser on the other end of the exchange. With a trained eye and experience, repetitive patterns on the charts and reoccurring price levels can be a telltale sign of what can happen next for a particular currency pair. At the bottom of the food chain lies the retail traders. If you are trading with your own funds from the comfort of your home or mobile device, you are within the retail bracket. Almost every trader not working for an institution or professionally trading other people's money are considered to be retail traders, making up roughly 3 to 5% of the total Forex market volume. As the smallest fish in a very large sea of whales, retail traders are the most disadvantaged as they lack the resources and insider knowledge that institutions have at their disposal. Therefore, they aim to make a profit by piggybacking off the moves created by the tier above them in the pyramid hierarchy, and also from the interbank liquidity providers. These higher level powerhouses frequently create manipulated environments within the market to lure the retail trader into traps, creating the necessary additional liquidity to aid their positions further. The goal of Forex as a retail trader is to accept you cannot beat the market and you cannot outtrade the higher tiered market participants. Your goal is to look at the clues left behind from the trading activity of the larger market participants, such as the candlesticks and wicks on your charting software, to ride the momentum the larger players provide. Everything you need is within the candlesticks themselves, as it is a blueprint of the psychological decisions deriving from the market makers. Once you can find the clues, you can begin to identify the profitable opportunities.